We are going to take on Chapter 13 this week. And finally, as it happens, we've been talking about this idea of the cost of capital for a while now. It has come up before, has it not? And we have been mostly considering it from the standpoint of the theoretical, conceptual notion of the opportunity cost of capital, haven't we? And we've been using, of course, what is the only correct notion of cost, which is opportunity cost. It's an economic concept. And we've had several notions in mind when we talked of the cost of capital. When we're talking about capital in finance, what are we talking about? I see it on Jario's lips that he held back. He didn't blurt it out. But Francine went ahead and said it. Money! We're talking about money. Money. In economics, if we utter the words capital, we're not usually talking about money, are we? What are we usually talking about if we say capital in economics? What kind of stuff? Buildings, machines, tools, the embodiment of technology into, as even so aptly put it, stuff. And the very nature of that stuff is that we don't care about that stuff in and of itself. It doesn't give us any psychic satisfaction whatsoever, that stuff. It gives us the means of making stuff that does give us psychic satisfaction. If we're talking about the cost of money, we surely must be talking about the cost of using someone else's money. Or, even if it's your own money, even if it's the money you already own, how you use it has an opportunity foregone, doesn't it? If you use it to buy a new plant, you cannot use it to buy new Xerox machines. If you use it to start a new line of business, you can't use it to continue the line of business you're in. You see? That's the notion of cost, the value foregone. What do you give up? All right, we do have that theoretical notion then of the cost of using someone else's money. In previous applications and contexts, we might have called it the discount rate. We might have called it the required rate of return. We had all these different notions that floating around. But what we're going to do in Chapter 13 is we're going to sort of now make a transition that would lead us quite naturally into the next course in finance, which is called Financial Management. But this chapter, Chapter 13, is a kind of transitional chapter in my mind, because we're now going to move from the purely conceptual notion of the cost of capital to an application of how businesses use it. So now we're beginning to step across the line away from theory into application. And if you take financial management, US 3830, you will find that that whole course is given over to the application of the theory of finance to real-world stuff. Okay? So, here are some questions. How much does a firm have to earn to stay in business in the long run? What would you say? Eden says what? Anything above average minimum variable cost, and you can stay in business in the long run. Can you?
Con says you can. Well, that's the short run.
I doubt if Con would say that.
No.
Yes, because eventually what will happen to your capital stock of real physical capital? It will wear out. It will be utterly physically depreciated, not just accounting and legally depreciated, but physically gone. So then what of your minimum average variable cost? Which is an economic idea, right? Theory of cost in economics will only get you so far in life. It certainly won't get you to the long run. Will it? No. So how much does a firm have to earn to stay in business in the long run? That means indefinitely. The long run is not any particular period of time. It is just indefinitely long. How much would you have to earn? Well, the correct answer is you must earn all of the opportunity costs associated with the business. Every factor of production must be paid, or what will they do? What will the factors of production do in the long run if they are not paid? The owners of those factors. See, what are the factors of production? Land, labor, capital, energy, material, you name it, all those things. If the owners of those things are not paid, what will they do? They'll leave. They won't be there for you to use. That includes someone else's money. Do you see? Okay, so what rate of return do investors expect from a firm even though they understand that the return is uncertain? If you are going to buy a share of IBM stock, C. Jarrell said, well, he thinks of the cost of capital, stock comes to mind. Well, that's not a totally ridiculous answer. It's just not enough of an answer, that's all. So if you were going to buy a share of IBM stock, why would you buy it in the first place? Yeah, you're not buying it for your health. You don't want to consume it directly. You're hoping that it will give you a rate of return. Well, what rate of return? Well, whatever it is, for whatever investor you are, there must be some rate of return, even if you haven't given it a number in your mind, that if the return on IBM stock falls below it, you'll sell it. And that's why we speak of the required rate of return. And surely that must have something to do with the cost of capital, huh? Because when someone buys a share of stock, what are they doing? They're turning over some of their money to the care and use of a corporation, are they not? Do they want it back? You're damn right they want it back. And more. They want it back plus a rate of return. Okay? So clearly that has to have something to do with the cost of capital for a firm. Firms have to decide among many competing uses for the capital they raise. How should they decide which capital projects to do? Well, we already have studied that, haven't we? Capital budgeting criteria, did we not? And we came upon the notion of net present value. Did we not? We did. But to calculate a net present value, what do you have to have? A discount rate. And what discount rate should you use to calculate the net present value of a capital project? Anybody? The cost of capital. Of course. Surely that's the right discount rate to use. Is it not? And if you're using the internal rate of return criterion, what hurdle rate must the internal rate of return be higher than? Well, not the risk-free. You're taking a project here that's got all kinds of risk. Why would the risk-free rate of return be interesting to you? If you're trying to decide whether to do this project, it's got risk. Why would you want to use the risk-free rate to compare the internal rate of return of the project to? Remember, the internal rate of return says, we'll only do this project if the internal rate of return of the project is higher than what? Guess we've forgotten everything we ever knew after eating all that turkey. The cost of capital, for goodness sakes. Yes. What if you undertake a project where you earn only the cost of capital? The internal rate of return is exactly equal to the cost of capital. What will the NPV of the project be? Zero. In which case you do what to shareholders' wealth? Doesn't add anything to it. Why in the world would a shareholder be interested in that project? Of course, labor unions would be interested in your doing that project as a corporation, because labor unions are only interested in earning their salaries and their bennies, right? They don't give one squat's behind about the owners. A little short-sighted of them, if you ask me, since without the owners, they wouldn't have a job of any kind. Think about it. Most people don't. But you're smarter than most people, so you will. Well, what is the value of a business, and how could it be estimated? Suppose you have a business and you decide to sell it. What will be the price that you would be willing to accept, and what would be the price that someone would be willing to pay? How could you come by that number? These are all very real-world questions, are they not? They are indeed. They're very interesting questions, and they are leading us into the thick of the real world of finance. On we go. Here's what we want to learn. When we're finished with Chapter 13, if we don't know these things, then we have failed miserably. If we want to be able to calculate a firm's capital structure, we'll do that, we'd have to know what it is, and we will surely learn that. We want to be able to estimate the required rates of return for securities issued by the firm. Well, what kinds of securities do firms issue? This takes us way back to the beginning, for goodness sakes, of this course. Stocks, bonds, dividends are not securities. Dividends are the cash flow arising from the security called a stock, right? So we got stocks and bonds, and those are the two big categories. And of course, within each of those big categories, we have different flavors. We have common stock, we have preferred stock, we have debentures, which is an unsecured bond. We could have a secured bond. Some collateral is pledged. We have all these different kind of financial securities. My goodness, if you read securities law, two things will be true. One, you will have great tolerance for ridiculous legalese. And two, you will find that just the definition of securities goes on for pages. A mortgage is a security, turns out. There's so many different things that are securities. Commercial paper is a very short-term security, isn't it? So all these, so we're going to have to estimate the required rates of return for various securities issued by the firm. Thank goodness we already know how to do that, mostly. We're going to learn to calculate the weighted average cost of capital, widely known by one and all as the WACC, weighted average cost of capital. So if you overhear a businessman on Wall Street talking to a businesswoman on Wall Street and say, "What's your WACC?" you will now understand that nothing very exciting is being discussed. We want to be able to explain when the WACC is and when it is not the appropriate discount rate for computing the net present value of a capital project. Aha! So here we have the ABC Corporation. They're all sitting around the long oval table, and they're trying to decide whether or not to undertake this capital project. And somebody says, well, the NPV of this is positive, and so it will add to shareholders' wealth. And then somebody else says, well, what discount rate did our analysts use? And someone else says the WACC, and the CEO says, well, there's the problem. We shouldn't be using the WACC for this project. What could he possibly be saying, and why? Shouldn't be using the weighted average cost of capital in this case because the weighted average cost of capital evidently will be incorrect for this particular project. What could make that so? Project could have greater risk than the average risk of the firm, which might be measured by what? What might you use to measure the risk of a particular project? How about the beta of the project? Would it be possible to calculate the beta of a project? The answer is yes. And if the beta of the project is greater than the beta of the firm, then you shouldn't use the WACC. It's too low. Interesting stuff. We're going to be able to use the WACC to value a business if we had forecasts of future cash flows. That's a really big if, isn't it? Where in the world would you get estimates or forecasts of future cash flows for a business, for goodness sakes? Well, if you can't come up with them, then you have no way of valuing the business is the problem. So it gives us at least a methodology for going about that difficult question of trying to figure out what is a business worth? What is its value? By the way, it should strike you that if that business is a corporation, what is the business worth? If it's a publicly traded corporation, what is the business worth? Well, it ought to be worth its market share price times the number of shares outstanding, shouldn't it? That is its market value, is it not? Corporations have only two fundamental sources of capital. What are they? They fly off the tongue, debt and equity, right? You can either borrow somebody else's money, that's debt, or you can coerce or persuade or somehow get someone to give you their money with no promise whatsoever of it being returned. That's what equity is about, isn't it? Buy a share of stock, what promise do you have that it'll be returned? None. None. Not just not much. Zero. There's absolutely no promise associated with buying a share of stock. None, right? With a bond, you have a promise to get repaid, don't you? That's why stock's riskier. You can go sue somebody to get at least part of what you're owed back, maybe. What can you do if a company goes bankrupt and you own shares of that company? Look in the mirror and say, guess what, buddy? You were wrong. A bad choice. Suck it up. Right? So, and then there are these various flavors, right? Bonds, short-term bank loans, long-term bank loans, commercial paper are the most common forms of debt. Equity, of course, common, preferred, and paid-in capital. What's paid-in capital? That's when the original founders of the firm say, I'm putting this much of my money in the firm. That's paid-in capital. Okay? Since capital comes from different sources, all these different potential sources, and this is just a short list, right? Long-term bank loans, my goodness, how many flavors of long-term bank loans do you suppose there are? Good gracious. Who knows? So anyway, every source of capital comes with a different cost, potentially, doesn't it? So it should strike you immediately as sensible that we're going to need to calculate a weighted average cost of the different sources of the firm's capital. Commercial paper is very short-term. In fact, by law, it can't have a term longer than, I believe, 81 days or something. I can't remember these details. They elude me after a while. It's a corporation financing short-term money directly with a purchaser. So who do you suppose buys commercial paper? Not you and me, right? It's going to be a large bank like Citibank or an investment group or mutual fund, you name it. Some source of capital that's really large. And the corporation will sell commercial paper directly to a purchaser to raise short-term funds. So, for example, a firm might need to raise $10 million quickly to meet some debt coming due. It's kind of like a bridge loan. You obviously can't live on commercial paper, can you? The firm can't finance its operations with commercial paper. It's a short-term matter. Maybe it needs to meet a payroll, and the big money is not going to come in till 3 weeks after the payroll had to be met. So they might float some commercial paper. So it's a short-term loan. It's just like you and I are doing when we go buy something on a credit card. We're sort of, in what sense? Well, it's unsecured, isn't it? Commercial paper is an unsecured loan. That means if the corporation doesn't repay, too bad. Whoever bought the commercial paper just loses. It's not collateralized in any way. It's just a loan on the name of the corporation. Well, that's what a credit card is to you and me, isn't it? Credit card's unsecured debt, isn't it? What if you don't pay your credit card bill? Can they come get your house? Not a bit of it. It's unsecured debt. They can turn it over to a collection agency and they can harangue you for the next 5 years or something unless you tell them don't call me anymore, in which case they can't call you anymore. So commercial paper is unsecured short-term debt issued by only the largest corporations. Why only the largest corporations? No one will buy it from small corporations. That's why. Too much risk, right? Okay. So on slide 12-6, the firm's weighted average cost of capital depends on two elements. The first one is what we're going to call the firm's capital structure. Technical term, we're going to see what it is in just a minute. And It depends on the required or expected rates of return that investors have for each source of capital. So now we're beginning to call upon some terminology that we've used before, the required rate of return or the expected rate of return. We do understand that those are fictional terms, don't we? They're theoretical terms. If I walk into the room and I say, by golly, Francine, what's your required or expected rate of return for giving someone your money? What would you say? Don't know. You haven't asked yourself that question, right? But if you were a money manager, you would have asked yourself that question. And before you bought some corporation's securities, you'd have a number in mind, wouldn't you? And so, of course, in the large financial market and the big leagues, as it were, of securities and Wall Street and finance, those people have a number in mind. You and I, not so much. All right. Okay, so the firm's capital structure comprises the shares. Now here's the definition then. The shares or percentages of its capital sources. That's all the capital structure means. And the shares, of course, must add up to 1. So in the simplest case, you could have your financing as a corporation, your financing of your physical and real assets could be 60% debt, 40% equity. In which case, you have a 60-40 capital structure, debt to equity. Right? That's all the word means, capital structure. Where's your money coming from? The firm's capital structure must be calculated using market values, not book values, if we want to come up with the WACC. You could calculate a firm's book capital structure, but that's based on history, isn't it? That's based on historical prices, what you originally paid for something, and perhaps depreciation figured in, which is just a legal and accounting function. What we're interested in when we talk about capital structure is according to market values of the securities that the firm has issued. Okay? Big difference between market values and book values. Frequently, for successful firms, the market values of securities are greater than the book values, aren't they? Sure. Because firms grow. Successful firms grow. That causes the market value of the securities to go up, doesn't it? The book values are just the book values. So a company might have issued shares of stock in the initial public offering for $20 a share, and its shares might now be trading for $70 a share. Well, if you use the $20 per share that are the book values of that equity, you wouldn't have much of an idea of what was really going on, would you? Why? Because you wouldn't have much of an idea of what investors are actually willing to pay for the firm. All right, on 12-7, we see this nasty-looking equation. You knew there had to be an equation involved, right? Well, it's not as nasty as it looks once we sort it out. Let's do that. The WACC, in simplest case, is D divided by V. Well, what's V? That's the market value of the firm. The market value of the firm. If it's a publicly traded corporation, that's easy to come by, isn't it? D is the market value of the firm's debt. E is the market value of the firm's equity. Okay, so we've got debt, we've got equity, and we've got value of the firm. So D divided by V is the share of the firm that is debt. E on V is the share that is equity. If you add D on V to E on V, what must you surely get? 1. Now, what if you had different kinds of equity? Well, then you'd have, say you had 2 different kinds of equity, common and preferred stock. Then you would have 2 E's on V, wouldn't you? You'd have E's of 1 on V and E's of 2 on V, and you'd have to have additional terms here. All right, so what do we have here? We have expected, now this E is not the same as this E, okay? This would be slightly confusing to the ordinary person, wouldn't it? This E on V is the equity. This E stands for expectation, the expected value. All right, so that could be a bit confusing without explanation, couldn't it? Indeed. So E of R sub B, or E of R sub B, that's the expected return on debt and the expected return on equity. Who's doing the expecting? Very confusing terminology, isn't it? When I write down the expected return to debt, who's doing the expecting? Shareholders don't care about debt. First thing you need to understand is that this is this theoretical construct going on here, and that there is no one doing the expecting of that return. And somehow we're going to have to come up with what we're calling the expected return to debt. We're going to have to come up with something we're calling the expected return to equity. How are we going to come up with those? Well, that's part of what we're going to have to recall, because we've already studied it, actually. Let's see if we remember anything. Oh, this is too torturous, right? How would you go about coming up with the expected return on equity for a firm? I can think of 2 ways. I can think of 3 ways. One's called the WAG. That would be the wild ass guess, right? One's called the capital asset pricing model, and the other is called the dividend discount model. Either the dividend discount model or the capital asset pricing model can lead us to a calculation of an expected return on that security, can it? We've already studied those things, thank goodness. It'd be too late to do it now if we hadn't already. All right, so we know that the shares of the capital structure have to add the 1. In the simplest case, well, in the very simplest case, we could have just one source of capital, couldn't we? Could be totally equity financed, couldn't it? Is it likely that a firm could be totally debt financed? Not very. Who will lend you money, even if you're a small business, maybe particularly if you're a small business? Who will lend you money if you don't have some skin in the game? Only a total fool, or your mother, as Francine says. Your mother may lend you money even if you are a total fool. Right? So it's possible that we could have a company that is totally equity financed, in which case its capital structure would just be 100% equity. It's very unlikely that any firm would be totally debt financed. Most corporations of any size at all have some debt. Some corporations have a lot of debt on purpose, just as Ethan says. Some corporations may have as much as a high as a 60 or 65% debt structure. What kinds of companies do you think those would be? What kind of corporations might we expect to have a high debt-to-equity ratio? Who? The government. The concept of equity doesn't even apply to the government. The concept of debt does. But in terms of businesses, what kind of businesses would you expect and be quite just, if I walked in and said, well, this company has a 70% debt structure, or 70-30 debt equity structure, you wouldn't raise an eyebrow. As opposed to which kind of companies would you say, oh God, they're about to go under, aren't they? Nothing comes to mind? All right, well, we'll hold that till financial management, since we do study it there. In any case, there is method to this madness. Now, what's this business about 1 minus t in here? Well, because we have the stupidest possible tax code on the planet. We do. It's called the Federal Income Tax Code. It is monumentally stupid. It's monumentally unfair. It's monumentally just moronic. We tax corporations in the United States. We actually have this silly notion going on in silly heads that corporations pay taxes. Duh! Corporations remit taxes. Who pays taxes? Persons pay taxes. Corporations are not persons. So who do you suppose ends up paying corporate income tax? Well, there's only a few persons involved that could. It could be the owners, or it could be the laborers who work for the corporation, Or it could be the consumers who buy from the corporation. In no case does a corporation pay taxes. If I ask you, does a corporation pay its own electric bill, what would you tell me? No, they remit it to the utility. Who actually pays the electric bill? Everybody understands that it's in the price of whatever it is they sell. Why don't they understand that when we start talking about taxes? Probably because the whole economics profession leads people astray about it, except me. There are a few of us who've got it sorted out. People pay taxes. And so we do have, though, going on in our tax law that to the extent that a corporation finances its operation with debt, it does not have to pay taxes on all of the revenue that it makes, because part of the debt, in fact, will be counted as a cost of doing business. So what do corporations pay taxes on? They pay taxes on net revenue, not total revenue. What's net revenue? Net revenue is total revenue minus cost, right? And so then we get to net revenue, and that's what corporations pay taxes on. Well, because our tax law says debt is a cost of doing business, they don't have to pay taxes on that part of revenue that is supported by the debt. So this is 1 minus T comes in here. We need the tax rate then in order for us to figure out the weighted average cost of capital if we have some debt. The after-tax required return to debt is therefore less than the pre-tax return by the factor 1 minus T. If that makes immediate sense to you, good. If it doesn't, you're going to have to work through some examples to see what's going on. Okay? But there is that 1 minus T. Of course, what happens to the 1 minus T if debt goes to 0? It goes away. Because now you have 0 times anything will be 0. So the 1 minus T wouldn't even factor in. Or what happens if a firm doesn't make enough income that it has to pay taxes? Well, then the T goes to 0. Okay? And 1 minus 0 is 1, so you see what happens in the formula. So on 12-8, slide 12-8, the expected or required rate of return on debt, which we're denoting E of R sub D, is just the market rate that the company would pay on new debt. If it were going to issue new debt, what would it pay? What would the coupon rate, in other words, be on its bonds? Well, what coupon rate would a company put on its bonds if it's going to issue new debt? No higher than has to, right? And as low as it can get away with. What would you call no higher than it has to and as low as you can get away with? I'd call it the market rate, determined by the willingness and ability of people to buy that company's debt. The firm can't attract capital on new debt unless it meets the market, can it? And so if you are the XYZ Corporation and you decide we need to raise $50 million to finance this project, and we're going to do it with bonds, what's the first thing you're going to be interested in? What's the going market rate on bonds of similar risk that we're getting ready to issue? And that can be found in the newspaper, can't it? Look it up in the Wall Street Journal. If you can find some companies that are similar to yours in risk or a project, companies that engage in projects that are similar to the project that you're getting ready to consider, you can figure out what the required rate on your new debt's going to be. You wouldn't want to use your old debt. Why? Because you've got some outstanding bonds that are carrying a coupon of 7%. Would that tell you anything at all about what your WACC is? Say that again. He then says, suppose that you have some old bonds that you issued 12 years ago and they still have 3 years to run before they mature, and they have a coupon rate of 7%. What will that 7% have to do with your weighted average cost of capital? Answer, nothing. No, because it's not, it only has something to do with your weighted average cost of capital if you could issue new debt at 7%. Can you? Well, now, who knows? That depends on what's going on out there in the marketplace. You see? When a new bond's issued, what 3 yields are all the same? the current yield, the yield to maturity, and the coupon rate. Those three numbers will all be the same when a new bond is issued, with the possibility of being different by a couple of basis points, maybe, just because the market's always in constant flux, right? So it is your new debt that you might issue that will inform you of the required return to debt. Recall that the market value of the firm's existing debt changes when the market rate of interest on new debt of comparable risk changes. So what in fact happens to the yield to maturity or the current yield on your 7% coupon debt if market rates change? So does the yield to maturity on your old bonds. Your coupon rate stays the same. That's part of the contract. And then, so man, we're digging way back now to stuff we've already learned or failed to learn. People who failed to learn it now are going to find out that they're clueless in Chapter 13 about this notion of required return on debt. The expected or required return on equity is more difficult to estimate. Why? Well, because it depends on risk of the firm's capital assets and operations. What can we know about a corporation? We can know its market price per share. How do we get from market price per share to expected return on equity? How are we going to do that? We're going to have to remember our model of stock valuation, the dividend discount model. Remember that? If we knew today's price and we knew next year's dividend, can we calculate the expected return on capital? Yes, we can if we make some assumptions about the growth of the firm. The growth rate. Remember that? G. Oh my goodness. So let's retrace why we're going through all this pain in the first place. We're trying to figure out the firm's weighted average cost of capital. And a few slides back we mentioned that it's going to depend on two elements. What two elements? The capital structure and the required returns on its securities. How are we going to know the required returns on its securities? Well, for debt, it's pretty straightforward. You go look in the marketplace and you can figure it out easily. Nobody's going to buy your debt unless they can see that it has the same rate of return as alternative debt that they could purchase of equal risk, right? And those are just market rates of return that are readily available in financial markets. But the required return on equity requires a model. You're not going to come by a required return on equity without using some kind of a stock valuation model, are you? There's more than one kind of stock valuation model. The only kind that we've studied in here is the dividend discount model. Is it not so? It is so. If you take my investments class, you will study other kinds of stock valuation models. On to slide 12-9. Financial managers use the capital asset pricing model to estimate the required rate of return. But look what you've got to know. Here's what we're after. The expected rate of return on equity. What we need to know? We need the risk-free rate of return. We need to know the market risk premium, do we not? That's the market risk premium. And then what do we need to know? The firm's beta. Where are you going to get the firm's beta? Well, these days, you just go to the internet and somebody's estimated it for you, haven't they? There must be 100 different places that you can find in 3 minutes that report different firms' betas for publicly traded corporations. Where are you going to get the firm's beta for a private corporation? Less easy. Where are you going to get the firm's beta for a firm that isn't even a corporation? So we began to see that this is no panacea, but it is a framework for us to think about the required return on equity for a firm. We could use the capital asset pricing model. Using the capital asset pricing model requires an estimate of the beta and perhaps a project-specific beta. Because what if this project that you're getting ready to finance has greater or less risk than your firm as a whole. And you wouldn't want to use the firm's beta because that is a reflection of the average riskiness of the firm. If this project is greater risk or less risk than the average risk of the firm, for whatever reason, then the firm's beta wouldn't be the right one to use. Mature firms, it says on slide 12-9, that have a fairly constant expected growth in dividends. See, this wouldn't be applicable to a new firm, would it? New startup, is it going to have a constant growth in dividends? Probably not. Might not even be paying any dividends. Probably isn't, right? It's probably retaining all the earnings to grow. But in any case, if you have a mature firm that's been around for a while and has a fairly constant expected growth rate, the G in the dividend discount model, well then you could use the constant growth dividend discount model to estimate an expected return on equity to plug into your weighted average cost of capital calculation. So a firm like Kroger, what do you think? Probably pretty constant growth rate in dividends over the long haul, right? How about Biogen, the all-new DNA research company? Well, we don't pay any dividends at all, and so the dividend discount model is going to be useless to you as a way of calculating expected return. You would have to either use the WAG method or the capital asset pricing method to come up with an expected return on equity. On slide 12-10, if the firm's capital structure changes, so will its expected rates of return on debt and equity. Now let's absorb the content of that statement. If I'm a firm, and let's suppose that I'm 100% equity financed, and I decide to take on debt, what will happen to the perception of the riskiness of my firm? I'm becoming somewhat leveraged, we say. I'm taking on debt, which is what leverage is. We'll study that in financial management at some length. And the perceived riskiness of my firm will go up. Why? Because I have to pay my debt interest. I have to pay the yield on my debt. I have to pay my coupon rate regardless of what my sales are, don't I? Otherwise, I'm in default. If you issue bonds, so here I am, I'm a company, I'm the XYZ Corporation, I've been 100% equity financed, we've got a new project that we want to undertake, we want to expand operations and put a new plant in Waskegi, and by golly, we're going to have to finance that plant with debt, and so that's going to take my capital structure to 20-80, 20% debt, 80% equity. Of course, the perceived risk of my firm is now going to change, isn't it? And so what would you expect to happen to the required return on debt and equity? Increasing the debt share of financing increases leverage and therefore financial risk, it says on the slide. We will study that in some detail, not in this chapter, but in financial management should you venture forth into that course. The increased financial risk will generally cause both the expected return on debt and the expected return on equity to rise. Now, the expected return on equity will rise simply because the shareholders say, wait a minute, we're in a different position now. You're exposing us to greater risk. You better be paying us a higher rate of return or we're going to sell your shares. They don't actually all meet in Philadelphia and talk about it. Some people sell their shares, right? Or don't, right? So we'll talk about that at greater length. In this particular chapter, it doesn't play much of a role. But changing the capital structure does not necessarily cause the WACC to change. This is very interesting. Even though the expected return to debt is generally lower than the expected return to equity, that would be true, right? Because debt is less risky than equity in general. The D on V is rising, but the WACC depends on the product of D on V times the expected return on debt. And they're moving in different directions, aren't they? And the E on V times expected return to equity. So if my debt share is rising, I'm weighting in a lower required return, but then what's happening to the E on V? It's falling, and the expected return to equity could be rising, you see that you could have offsetting changes going on, and that the WACC wouldn't change at all necessarily, even though I change my capital structure. And in fact, in financial management, we're going to encounter the famous M&M debt irrelevance proposition, but we won't encounter it here. M&M stands for Modigliani and Miller, two chaps that won the Nobel Prize in financial economics one year for coming up with a few propositions that were significant enough that they were awarded the prize. But in any case, for our purposes here, we wouldn't necessarily expect the WACC to change just because the capital structure of the company changes because of offsetting factors in the shares and required returns. If we have no corporate income tax, the WACC could remain constant when capital structure changes. But what happens if you have corporate income tax? Well, then you have that 1 minus T business going on in there. And if you change your capital structure, you get an advantage out of debt, don't you? If you were 100% financed as a corporation and you went to a 50-50 debt equity, guess what happens to the value of your firm? It goes up. Why? Because now you're getting a tax advantage, and that tax advantage will be capitalized into your share price, believe it or not. Wow. Why don't firms then finance themselves with 100% debt? The only answer is they can't, or they would. Because with the tax advantage, that would be to their advantage, wouldn't it? It would be to the shareholders' advantage. Well, wait a minute, there wouldn't be any shareholders if they were 100% financed with debt. Okay. Well, we'll revisit some of these ideas in chapter, actually it will be 16 by the time you get there, instead of chapter 15. But in this chapter, it doesn't really come into play. We're just sort of previewing it. On slide 12-11. Hope we're getting near the end. I'm sure we are. If we think of the whole business as just a large, variegated capital project, we could realize that we could estimate the value of the whole business by discounting the firm's future free cash flows to the present. But we'd have to be using the firm's WACC as the discount rate for that to make any sense. So if we can figure out the net present value of project, we can figure out the present value of the whole firm, can't we? If we knew the right discount rate to use and if we knew future free cash flows. When we say free cash flows, all we mean is that's the cash that's left over after everybody else is paid. So who owns that cash? Well, the shareholders do. The owners own that cash. Some of the cash that's earned by the firm is owed to whom? Well, debtors. The debt bill, right? You've got to pay your coupon rates and all that, and some of it's owed to other fixed costs that you've incurred and you have to pay, right? Your contractual costs. Well, whatever free cash flows are remaining into the future, if we knew those, don't ask me how we'd ever know those, but if we knew those, and we knew the firm's WACC, well, guess what we could do? We can figure out the value of the firm. We can come up with a very reasonable estimate of what this firm is worth. Operating cash flows, that's an accounting term, are after-tax profits plus depreciation. Why do you add back depreciation? Because depreciation isn't a cash flow, is it? It's an accounting entry. Remember that from Accounting 201 or somewhere you took accounting? I remember taking accounting, but I don't quite remember. No, okay. You might have to review some of that accounting, and we do that in financial management too. We spend one chapter reviewing our accounting because we need to understand that much of accounting. We subtract future outlays for plant and equipment and net working capital. What's that all about? Well, our capital is going to wear out, isn't it? We know it's going to wear out. We're interested in the going value of the firm as a going concern, as a continuing concern. And so we have to anticipate that our capital is going to wear out when we calculate free cash flows. And so we have to build in outlays for replacing the capital and net working capital. What in the world is net working capital? Gosh, you expect me to remember that?
It's all capital value.
What is, I think it's current assets minus current liabilities, isn't it? And I'm not even an accountant. How do I know that? Beats me. Sometimes I don't even know my passwords, so how I remember that, I don't know. Anyway, when you do all that, you get free cash flow, FCF. When you do those adjustments, the accounting data, you get free cash flow. Then if you discount the future free cash flow using the company's WACC, guess what you get? The present value of the whole business. And that should be your asking price going in to the negotiation when you get ready to sell. And then, of course, what is the other side who's negotiating with you going to do? They're going to say, where the hell did you come up with those free cash flows? And what makes you think your WACC is that number? Right? And the debate begins. And how does the debate end? Not necessarily. Even said compromise. No, it could be that you're just better negotiating and bargaining than they are, and you get what you want. That they want your business so bad that they're going to pay whatever you ask. Or it could be the other way. It could be that you end up taking a discount off of what you think the theoretical value of your company really is. In the end, what is it going to depend on? Judgment. You can only go so far with theory.